Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Yes, welcome to Ask Rob and Rob, the show where you bring the questions, we bring the answers, and in under 10 minutes' time we'll all be a little bit wiser. That's the intention anyway. To make this work, we need two essential ingredients. You need us, and we're here, so that's fine. But we also need your questions. So Rob, how does somebody get their question answered by us?
We do need your questions, but we make it easy. You can call in on 013 808 00035. Normal rates apply. Rob answers all calls personally. No, he doesn't. It's an answer phone. If you get it wrong, just re-record it. Or you can go to thepropertyhub.net/ask. That's thepropertyhub.net/ask, and you can submit your question there too. Easy peasy. And that's exactly what Giles from York's done.
Hi, Rob and Rob. This is Giles from York. First of all, thanks for all the content that you put out. Always much appreciated. I have a quick question for you. So, with the change to tax rules around offsetting mortgage interest and the move to many people investing through limited companies, I just wondered, do you think that interest rates will rise faster than competition in the limited company mortgage space can drive down costs? So, for example, if I took a mortgage out now at 4%, do you think in 5 years' time that I will be paying more interest because interest rates will have risen, or do you think I'll be paying less interest in 5 years' time because competition in that sector will drive down costs faster than interest rate rises? Really happy to hear your thoughts. Many thanks.
Good question. Like this one. Really interesting. And I like the angle you've taken here because it's something that I think most people won't appreciate. What am I talking about? Well, at the moment, interest rates, on average for a limited company, are around 4-ish%, maybe 4 to 4.5% as we record this podcast. But interest rates, as you are probably aware, are dramatically lower. So the margin between what the banks or the lenders will borrow at and what they are charging you is pretty big. For example, a buy-to-let mortgage right now is nearer 2.5%. So between 1.5% and 2% difference. That's quite a nice healthy profit for those in a limited company mortgage space. So in 5 years, interest rates will have risen. There's no doubt they would have. By what level? Don't know. Do not know. So this makes it slightly harder to answer. But let's make an assumption. Let's say in 5 years' time, interest rates have gone up by 2%. And now you would say, okay, well, that means my mortgage would be 6%. If they're 4% today, they would be 6% in 5 years' time. Not so. And I would say highly unlikely. And the reason behind that is because the mortgage market will get more competitive. The market for limited company lending is still in its infancy. It's really new. It's been around for a while, but in the form that it is today, because so many people are buying through limited companies, it's so new. The companies aren't used to the demand. New companies and lenders are coming in all the time, and competition is driving down rates, and it's also driving up service levels. But a year ago, the average interest rate was about 5% for a limited company mortgage. Now it's 4%. Interest rates haven't changed, lending hasn't changed, what's changed is competition. So, in 5 years' time, if rates have gone up by a couple of percent, will mortgages be around 4% still? They might even be less.
Yes, spot on. I think the summary is interest rates, yes, in 5 years' time will almost certainly be higher. The margins will almost certainly be lower. And there's room in the limited company sector, especially for margins to come down even further. So interest rates are going to do what they're going to do. But I'd say it's likely that before too long, limited company and personal mortgages are going to be near enough equivalent. And you could expect the margins for both of those to come down as base rate goes up and competition remains intense. So Giles, really good question. Thank you for that. Something a lot of people are going to be wondering, I'm sure.
Well, I'm wondering, Rob, has everybody learned that number we give out every week?
Well, someone certainly has. This question is from Mandeep, and we've got into his brain.
Hi, Rob and Rob. This is Mandeep Sidhu from Leicester. I also invest in Coventry. I'm a big fan of the show and everything you guys do, so much so that I didn't need to look up your phone number. I somehow already knew it. That's really weird. I've got a question for you. I, at the moment, invest mostly in HMOs and a little bit in single lets, but I'm more and more looking at single let flats in my investment area, which is Coventry, and the numbers do look pretty good in terms of what you can buy them for and what you can rent them out for, and it is quite a good return. What I'm a little bit uncertain about is how to figure out what the renewing of the lease may be at some point in the future, and how to go about calculating what might be the real net yield, considering that cost in the future. The ones that I'm seeing are typically 80 years, sometimes 100 years, and very rarely there's some that come up that are 125 years. So I'm more worried about the ones which are 90 years, because I think they may survive a mortgage term, but then there's going to be some depreciation because of the lease factor, but then they may have gone up in value. So I just wanted to know, as you guys invest in flats, how do you project that, and how do you consider what the future cost may be to renew the lease? Thank you very much, and look forward to hearing your reply. Thank you.
The brainwashing has worked, Rob. At last, the master plan for us to take over can begin. Or maybe we'll just get more questions.
Yeah, that's awesome. Remember when you were a kid and you knew all your friends' phone numbers off by heart? We kind of will bring you back those days. Everyone's going to have one number they can remember. Hopefully everyone's going to be able to remember their own and ask Rob and Rob. And that's about it. That's the plan anyway. Well, Mandeep, thank you for that question. Lease extensions, it can be really hard to put a figure on it, as you found. The best you can really do is to get an estimate. You can either get an estimate by going to a leasehold valuer, who you'll be able to find locally. They'll probably be able to give you the most accurate estimate, but how much they'd be willing to tell you without you actually paying them money, I'm not entirely sure. Or you can get a slightly broader estimate by going onto the Leasehold Advisory Services website. They've got a calculator on there where you can pop in the property value, the current annual ground rent and the length of the lease, and it will give you a sort of a ballpark figure of how much you could expect the lease extension to cost. It's all a negotiation, so you can't be completely sure, but it's sort of based on a formula. So for your purposes, because it's not something that's an immediate concern, it's just something that you're thinking about for the future, that estimate is probably going to be good enough, and it's not going to be absolutely miles out. So that'll be enough for you to make a decision. You can then think about that in a couple of different ways. So if you wanted to, you could take that cost and effectively add it to the purchase price and then calculate your yield based on that. So you're taking that future lease extension cost and treating it as a cost that you've got now. But I would say, as this is, again, something that you're only looking for at some point down the line, I wouldn't really treat it that way. I'd just treat it as a cost that you know you're going to have at some point, and therefore you can either sort of be putting some of the rent aside, or you can say, well, I'll probably have had some capital growth by that point, so I'll remortgage, or treat it that way. So you're right to be thinking about it, but until you get down close to that magic 80-year mark, at which point things start to get a bit trickier, you probably don't have to worry all that much. The process of a lease extension isn't all that scary. It just takes a very long time. I said on the podcast ages ago that I was going through a lease extension and I'd talk about it more once it had finished. I still am. It's not difficult. There's not all that much to do. It just takes ages. So all in all, one of those things that I think sounds a little bit scarier than it is. You're right to be thinking about it, but don't worry about it all that much.
Well, it sounds like it should be the least of your worries right now, Mandeep.
Oh.
You've brought me on for a reason. Okay. And another reason I'm here is to remind you how easy it is to submit your questions. You can be like Mandeep and memorise the number, which is 013 808 00035, or get involved with thepropertyhub.net/ask. So that's us done. Another Ask Rob and Rob. Another couple of questions boxed off. We'll be back next week with at least a couple more of your questions. And, of course, we'll be back this Thursday with the Property Podcast. Make sure you catch both of those. But until then, take care. Have fun. Bye-bye.
Bye-bye.